Great, thanks so much, Gary. You good, Kelly?
There's one more here.
Okay, so welcome to the alternative credit funds and fintech discussion. My name's Garen, and I have the privilege of introducing this great panel here. We're going to spend the next 20 minutes or so talking about this topic, and please, if you have any questions, we are going to reserve 5 minutes at the end. So I'll leave it to the panel to introduce themselves, and maybe we'll start with Dave.
Hi, everybody. I'm David Jens. 10 years ago, I founded what's now called Merchant Growth. We're a small business credit provider. When I founded Merchant Growth, I was 22 years old. I wasn't particularly wealthy or connected, and so I basically had to string it together with friends and family money for many years. And it wasn't until I was 8 years into the business that I got my first institutional credit facility. And so, I recognize that there's a large gap between, having an idea for a fintech credit providing business and being ready for an institution. Some people are fortunate enough they can go right out the gate with the institutional money, but I do believe there's a big gap. And now our funding vehicle, where the friends and family originally invested, it now has a 10-year track record and quite a bit of capital. And so that funding vehicle is now starting to support other platforms, other new fintechs, and we now support 5 other platforms in addition to our own. And so, yeah, I just think it's kind of, it's related to the earlier panel where we had lenders talking about lending to lenders, but there's also, other forms of capital and pools of capital that are forming to serve sort of the smaller originators that aren't ready for institutional funding yet.
Colin?
Hi. Is that on, yeah?
Yep.
My name's Colin Kilgour. I'm one of the founders and partner at Kilgour Williams Capital. We are a Toronto-based credit investment manager. About 2.5 years ago, we launched the Kiwi Private Credit Fund, which is an alternative credit fund to invest in whole loans originated by online lenders. And this has taken some evolution in the terms being used over the years. It used to be called peer-to-peer lending, then it evolved to marketplace lending, and more recently, it's as an inclusive term, online lending. We buy whole loans in the consumer space. We buy prime consumer loans, unsecured. We buy small business loans, so typically merchant cash advance loans. And we also invest in first lien mortgages to developers.
Thank you. Kelly?
My name is Kelly Kladek. I'm a co-founder of a company called Cypress Hills Partners based out of Vancouver. Our business is as a direct lender. We focus on primarily, majority of our capital is lent into the specialty lending area, so funding other funders. To date, our fund, which is structured as a limited partnership, we've funded approximately $100 million over the last 4 years into the space. Our majority of our investors to date are institutional investors, with the exception that we create an alignment where the general partner can invest up to 10% into the funding vehicle. We, as David had mentioned and Colin, have supported the specialty lending space in Canada, which is where majority of our capital is deployed.
Fantastic. Okay, so let's start with a few questions here. So the first question is, what are the best practices for valuing a portfolio? And there's kind of 2 ways maybe you can look at this. Is if you're investing in a portfolio, what are the best practices to value it? And also, if you have a portfolio, how would you be best suited to present that to an investor? So Kelly, do you have
Sure.
some thoughts?
As I mentioned, majority of our investors are institutional investors, and under, I guess, IFRS 9 does impact both methodologies, which can be amortized cost or fair market value. But given the fact that the institutional investors have liquidity requirements and want to mark to market their portfolios, we were guided down a path of creating that type of valuation for our fund. The key metrics that we look at are, there's primarily 3 of them. Majority of our capital is, the collateral is in the consumer loan space. So we're looking at loan losses. So with our own proprietary data, we're creating our own loss curves to determine the ultimate the ultimate behavior of the loans. We also look at prepayments and discount rates. The discount rates are a little bit tricky in Canada because, as you can see, there's not a lot of different funders in this space. So the US market is quite efficient, so it makes it challenging to use their discount rates as an indicative metric. So we actually will look for smaller markets, such in places like Europe, where we can find similar types of portfolios.
So, like you, we are IFRS 9 compliant. That requires us to value the portfolio. Since we take subscriptions monthly and redemptions monthly, we have to have a strike a NAV every single month. So that requires us to mark every single asset in the portfolio every single month. We use a third-party valuation agent, so we're not marking our own book, which is tends to be frowned upon. And it's model-based. So because these are not traded instruments, we have something like 2,700 loans, individual loans in our portfolio. We use the third-party firm has their model. They model essentially every single loan and give us a mark-to-market on every single loan. Roughly, current loans come in around par. Once a loan goes about a day delinquent, we start taking about a 15% write-down on it. And by the time it hits 60 or 90 days, it's already about 85 or 90% written off.
Yeah, in our case, out of the 5 portfolios, most, we're taking, it's just taking accounting book value in our case, keeping it pretty simple. On one of the portfolios, there is a NAV model, which is a discounted cash flow model.
Great, thank you. So there's obviously lots of liquidity in the marketplace today. We see funds being raised at a record pace and funding at a record pace. So I wonder, when you take a look at your portfolios and you are concerned about the clouds on the horizon, which asset classes do you think are most likely to survive that full cycle, and which are you most concerned about?
Sure. So we're in 3 different asset classes. We're in unsecured consumer, but prime unsecured consumer. We are in small business lending, and we are in first mortgages. So if we see, and as a clarification, we are almost exclusively invested in U.S. loans. So our economic focus is on U.S. If we see storm clouds on the horizon, a couple things we're likely to do is probably look to more secured lending rather than unsecured lending. So maybe overweight the mortgage side of our portfolio, underweight the unsecured consumer part of it. But that said, we are pretty bullish on the U.S. credit market, at least for the next 18 to 24 months. So it's not something we lose a ton of sleep over these days, but we are watching all the time. And with a portfolio duration of about 10 months to a year, that's kind of our window of where are the storm clouds.
Yeah, in our case, we're in business lending, both secured and unsecured, and we're in unsecured consumer lending as well. And I actually quite like non-prime portfolios that have a really healthy net interest margin. I actually think that in some cases there's more risk in prime than there is in non-prime, because a non-prime portfolio that has a loss rate in normal times of, say, 10%, maybe that goes to 15%. That's a 50% increase. Whereas a prime portfolio that has a 1% loss rate could go to 3 or 4, which is a multiple increase off of the base loss rate. And if you're dealing with a really tight NIM, that can really hurt your economics and start to chew into your equity capital pretty quickly on the prime side. So really like kind of healthy, high-yielding non-prime portfolios that are diversified across a number of different sectors.
So do you think the prime portfolios are going to get hit harder, and as a result, the subprime are going to have more opportunities?
I think in some cases that will be true, yeah.
Yeah, I'd reiterate what David said. Part of our initial work when we dug into the subprime sector was going back into the financial crisis and gathering data to create our own stress test models. And we came up with the exact same number where in the financial crisis, subprime loans increased by about 50% in the US, slightly less in Canada. So when we're looking at the spreads and the ability to look at a kind of a 3 times that type stress test, we feel quite comfortable in a downturn in that segment. And then I think the second part, and it was mentioned in a prior session, especially in the subprime area, the borrower that you're onboarding in the downturn usually is a higher quality because of the fact they've moved down from prime to subprime, and that becomes a high grade. And we've seen data on that where the performance coming out of a downturn actually can outperform going into it 2 years prior.
Can I just pick up on something Kelly said there? You talked about looking at what happened in the credit crisis, and that's an important thing to look at. That was the biggest credit event or credit crisis in all of our lifetimes in the room, I think, looking around. And we get invariably asked that by investors. It's like, what's going to happen when the next downturn happens or the next credit crisis? So modeling and backtesting against credit crisis where we have fairly recent and robust data enables us to kind of test our models and test our strategies. So I'm sure we've all done it on the stage in terms of estimating what would happen to your portfolio in a crisis. We've done it on ours, and we've said, well, if everything goes to hell in a handbasket exactly like it did in 08, 09, we're probably down 1 or 2% on NAV if we take that as the benchmark. And if you compare that to what's likely to happen to your equity portfolio or your publicly traded bond portfolio, we think alternative credit's a pretty good place to be in a downturn.
Yep, fantastic. Actually, Colin, why don't we stick with you, because you, although you don't have that beautiful Texan drawl, do most of your business down in the U.S. And I wonder if you could maybe comment on the differences that you see between Canada and the States.
Sure, I can start it off and the other guys can jump in. But we are a Canadian credit fund. I mean, we have Canadian investors, we're domiciled in Canada, but our investments, somewhat by necessity and somewhat by design, are almost exclusively in the U.S. And it's really because of the model we've chosen. We like the marketplace lending model or the peer-to-peer lending model where we are buying whole loans originated by online lending platforms. And that is a market which really had its genesis kind of just around or slightly prior to the credit crisis in the US with firms like Lending Club and Prosper coming out, and then many, many others. We've had a few come up in Canada, but very few have adopted that model. So our choice of operating model is to basically be a credit investor, not a loan originator like Kelly or David are. So we like to buy loans and we like to have them presented to us. And that model really hasn't taken off in Canada. Partly it hasn't needed to, there's been other sources of capital, partly because, quite frankly, the OSC and other securities regulators have made it difficult to launch those kind of models.
Well, I can't really speak on the cross-border because all of our investments in our fund are in Canada.
Okay, great. So the other question that we have is, how do we actually evaluate the platforms that you're looking at when you're investing? How important is the technology? How important is the platform of the originator when you're looking to make an investment?
Yeah, I could start there, I guess. I would say that the younger the business, the more the individual and the team matters. You obviously, if it's a really young platform straight out the gate, there's not going to be a wealth of static pool data to go over, and the underwriting guidelines are probably in flux, and you're still kind of in that learning stage, which is the stage that typically institutional money will never touch you. But in some cases, we've actually helped greenfield new platforms. Full disclosure, Merchant Opportunities Fund is the main backer of Venbridge, which is Garen's company. And so Garen hadn't done a single loan when we first started working together. So, it was really a bet on Garen's past experience, knowing his space and knowing that he'll do a good job in it. In other cases, we backed more mature platforms that have the static pool data, and then we kind of get a lot more quantitative around it.
I would say for us, one of the key differentiating factors is our collateral package of loans loan receivables that back our funds currently exceeds 22,000 loans. The data on that becomes very valuable for us to evaluate other opportunities. So as a result, we're able to look at earlier stage opportunities. The second part of the equation where we de-risk the facility is on the structure. So we look at a bankruptcy remote vehicle for each of our offerings, an SPV type structure to mitigate any sort of platform failure risk. And so as a result, because of those, we were able to look at earlier stage opportunities that have possibly less than 12 months of static pool data.
So we're a little bit different from that. We deal almost exclusively with established platforms. Again, we are a fairly conservatively managed credit fund, so we want to be dealing with guys that have a demonstrated track record and have some scale to them. So again, that's part of what's drove us to the U.S. We will look at a loan tape. So one of the things we like about the marketplace lending space is these lenders will provide to us for due diligence every loan they've ever written, every borrower, and every payment. And it's literally terabytes of data that we then are able to analyze and see their track records by vintage, by quarter, by geography, whatever. So we do a full quantitative analysis. Then for everybody, it's going to be an on-site DD. So it's meeting the entire executive team, the risk, underwriting, fraud, tech, servicing, and making sure you get a high level of comfort with their ability and the people they have in place. So it's you know, there's some hardcore number crunching, and then there's the on-site quantitative due diligence and the DDQ that goes with that.
I just wanted to add that in our case, our ability to you know, back a platform early, like in the Venbridge example earlier, what really allows us to do that is the fact that we run a platform ourselves and have experience running multiple platforms. You know, so when we're evaluating a business like a Venbridge, you know, we can see it through the lens of our own underwriting. We can tap members on our team to help, you know, advise or create operational procedures or so on and so forth. So that kind of makes us unique, that we're fund managers, but we also operate our own platform. So yeah.
Just on the technology side that you alluded to, of course, technology is an important factor. We view it more as a way to allow businesses to scale, to allow businesses to make their lives more efficient. We don't necessarily want to see their entire underwriting process completely automated. We still think, especially some of the earlier stage lenders, they need to really understand their credit box and understand some of the realities of some of the key attributes to have a successful performing portfolio. So it's part of the process, but it certainly we want to see the fundamentals there before we see the tech.
Thank you. So we heard from Craig this morning that it's basically steady as she goes within the next few months. But I'm wondering if we see that interest rates go to, or prime rate goes to 0% or to 10%, so things really fluctuate significantly from where they are today. And who knows, it might take 12 months, it might take 2-3 years, but it might be possible that we see that in economies. We've seen it in economies around the world. So how do you think that affects your portfolio?
The question is rising interest rates on a portfolio?
Either rising or falling, if the interest rates fall to 0.
Yeah, I mean, we're you know, our fund uses leverage, so you know, obviously the rise or fall in interest rates will compress or expand our NIMs. But in our case, we're primarily investing in non-prime credit with healthy NIMs, so you know, rising interest rates wouldn't squeeze us that much.
Yeah, we're kind of the same, and we have the same leverage issue if that were to affect our credit facility. Yeah, our weighted average coupon of loans in our portfolio is about 16%. So if LIBOR or bank rate goes up or down by a couple points, it's really not going to have a huge impact to the price of the loans that go out on the street from us.
For us as well, the majority of the underlying underlying loans have fairly healthy margins, are immune to any sort of interest rate fluctuations, and so as a result, our borrowers would be effectively immune to it, and so from our perspective, it doesn't impact us.
Okay, fantastic, thank you. So I'll open up to some questions now. We've got about 5 minutes, and if you just want to raise your hand, and I think it's probably going to be to talk loudly. One question? Yes, sir.
Sure.
Just repeat the question.
So the question was, when we look at prime versus subprime, do we look at things beyond just a FICO score? And I can take part of that, and then you guys can also address it. We use that term basically as we have a hard cutoff of 640 for our FICOs in our portfolio. But that's not how we evaluate the loans, right? So in the case of a consumer loan, we're looking at about 150 columns of data for every loan, as well as whatever is added on by the human underwriter. So prime versus subprime is a convenient term that we can use in a big group like this, and we all kind of understand what it means. But yeah, we're looking at 150 columns of data.
Yeah, for the consumer portfolio that we have invested in, that's more mature, as well as for our small business credit portfolio that's got the 10-year track record. In both cases, those platforms have been using statistical methods to risk grade their applications for many, many years now. So we really kind of take those, the A, B, C, D kind of buckets that they've defined in the risk metrics to kind of define prime or subprime, because especially, well, I think across the board actually you can really augment your understanding of risk through other data as opposed to just relying on a credit score.
I would say the primary factor in the near prime subprime area is the ability to pay and the ability to predict payment. The credit score certainly is an important factor, but there's a number of other data points now that specialty lenders will employ to predict that, and they do a very good job at establishing that and establishing some data points that they can predict upon. So it's certainly way beyond the FICO score.
Other questions? Yes, sir.
First of all, thanks panelists, and thanks Gary for moderating the panel. I'm loud enough, but this might help. So I got a question regarding small, medium enterprise borrowers, and specifically in the Canadian space, because Canadians are generally more conservative. They're a little lagging in terms of following the trends or being aggressive with taking risk and taking loans. I certainly was in that position a few years back. I'm just wondering, when you guys find borrowers in this space, do you guys have a push or pull tactic? Is it sort of like you look into your own database of previous SMEs that may be ripe to offer a loan to? Or do you sort of just wait for them to show up at the door, and what's the mentality around that? And would a database of all of these borrowers be valuable, and how do you guys evaluate that?
Yeah, I guess that's more a question for me. It's not really about how investing in a platform, but the small business platform, how it reaches its customers. It's a mix of push and pull, to be honest. So we do find that at Merchant Growth, some of our best customers are those that don't necessarily really need the money, so they're not actively searching for it, and those are kind of like the tougher sells, and a good salesperson can really sell them on the benefit to their business if they had access to credit, and so. There's definitely a strong outbound push, and that's where we see some of our best customers, but we also have inbound coming in through our own marketing efforts, as well as referral partners that we work with, and broker partners as well. So a whole bunch of different ways that we acquire customers at Merchant Growth.
One last question?
Would I like the database?
He's offering a database.
If he's offering a database, we can talk after.
Any other questions? Okay, fantastic. Thanks, Dave, Colin, and Kelly. Really appreciate it.